gentlemen, welcome to a Standard Bank webinar hosted by SBFC, Standard Bank Financial Consultancy. My name is Kate Ogunene, the coordinator, and today we are looking at business risk planning with Mr. Errol Meyer, Faiza Khan, and Jacques Retief. But before I hand over to them, I just want to do some housekeeping for those who are new to this. First of all, if you have any questions during the session, on your right-hand side of the screen, there's a small panel. There's a title that says questions. So during the session, you can type in your question and then we'll address it at the end of the session so that we don't disturb our presenters. And then second thing, before I start, I just want to make sure everybody can hear me where they're seated. It's going to be 45 minutes to an hour, the session. So just make sure your sound, the volume is as high as possible. And then just to give me a go ahead to carry on, there's a small high five on the very same panel where you'll be typing in your questions. If you find that small high five, if you can just click that for me, it will indicate on my side that sound is good and we can carry on. Thank you. Thank you, Shanaz. Thank you, Shane. All right, there's more high fives. Thank you, Nolene. Thank you, Jenny. All right, so I assume sound is good. So I'm going to introduce you to our panelists so you know who's talking to you from this side. First of all, we've got our resident DJ, Mr. Errol Meyer. He's a certified financial planner and an admitted advocate of the High Court SA. He holds qualifications in finance, law, teaching, and taxation. He's authored a book called Notes on Estates and Financial Plans, and he's a renowned lecturer, examiner, and moderator for various universities in South Africa, and previously worked as a legal advisor for corporates and as a tax advocate for SARS. He currently holds the position of advisory propositions legal specialist here at Standard Bank. He's going to be holding down the fort for us, and his two co-pilots today, we're going to have Ms. Faiza Khan. She's a senior legal specialist at Liberty. She has an LLB degree as well as her master's degree and is an admitted attorney. Faiza has also completed a postgraduate diploma in certified financial planning and is passionate about the financial planning industry and has been in this industry as a legal advisor for 7 years. And lastly, but definitely not least, is Jacques Retief. He has a BRS in LLB and completed a postgraduate diploma in financial planning. As a CFP, he is currently the lead for Liberty Legal Marketing Specialists. He has been in the industry since 1998, and he contributed to his fantastic industry as a legal advisor, wealth manager, business development manager, head of Advisory Center of Excellence, and part-time lecturer in financial planning law at University of Free State. And he's passionate about the financial planning industry. So those are our three pilots today. Hope you're going to have a safe journey. So I'm going to leave the cockpit for now and let Mr. Errol Meyer come in and start. And then we will see you at the end of the session. Good afternoon, lady and gent.
Thank you, Katiwe. Well, good afternoon, all attendees. Today we're going to talk about, and you'll see the slide there in front of you, we're going to talk about business insurance as well as personal risk insurance. So in this instance, we're going to talk about the business, and Faiza is going to take us through the business and all the business structures that goes with that. And thereafter, Jacques will follow, and he'll talk about the business owners. And on the screen, you'll see the A, B, and C. And thereafter, then we will have a panel discussion. I hand you over now to Faiza that will take us through the business aspects.
Thank you so much, Errol. Good afternoon, everybody. Let us maybe have a look at the different types of business assurance risk management solutions that are out there for business owners. So if we look at a business, you will know that a business has certain business owners. And if, say, for example, we speak of a business, like on the slide here, with 3 different business owners that each own an equal share in the business, it's important to ensure that when you're looking at a specific business and when you are a business owner, there are certain risks that you would need to take into consideration. So one of the risks that we look at is a surety risk. And what is a surety risk and what type of risk does it open up or does it open the business up to? So when you start a business, a lot of the time your business owners will require finance, and a lot of the time they don't have the money available, so they will approach a financial institution in order to receive funding. And financial institutions sometimes will require that the business owners sign surety for the finance. And it won't just be one surety that the financial institution will ask for, it will be all of the business owners. So in our example, we have 3 business owners, and all 3 business owners will be required to stand surety for any finance that is requested from a bank, for example. When you sign a suretyship agreement, there are certain consequences to that agreement. You sign as though you are a co-principal debtor. That means that you say that you will be liable for that debt that is outstanding, together with all of the other sureties for the full extent of the debt. And what that means is that there's certain rights that are excluded in terms of a suretyship agreement. Those rights are known as the right of excussion and the right of division. And the right of excussion really is where you could have the right to say to the creditor or the bank, you could say, well, please can you proceed against the business first to collect the debt, and then if the business doesn't have the funds, the sureties will then assist. But if you waive that right, it means that you are seen as a co-principal debtor with this business, and the bank can proceed against you or any one of the sureties for the full extent of the debt. And that is what joint and several liability is. There is also a right of division that is excluded, or that is waived in respect of a suretyship contract. And what the right of division says is that if I own 33% of the business, for example, or a third of the business, then I should only be liable for a third of the debt. And if you waive this right, it means that you will be, again, jointly and severally liable to the full extent of the debt. So it's very important that when you sign a suretyship agreement, that there is certain risk that has now come into play. And that risk needs to be managed. And how do we then manage that risk? And what is that risk really? So as a surety, if something happens to you, your estate could be impacted for this debt. So it's important that the business is in a position to manage this risk and to protect the estate of the surety from any potential liability. So how would you go about ensuring that this risk is managed? One of the solutions could be a life insurance policy that is owned by the business on the life of a surety, and that ensures that should something happen to any one of the sureties, the life insurance policy will pay out to the business, who is the nominated beneficiary on this policy. The business is also the owner of this policy. So it makes sense that the business is the owner, the business pays for the policy, the business must benefit from the policy. And when the business receives the proceeds of the policy, should one of the sureties pass away, the business is now in a position to settle that debt. When this debt is settled, there's certain advantages that come into play. And that basically is that the business has now settled that debt so that any credit lines can remain open and the business can continue to do business with a financial institution. The other advantage is that the estate of the surety itself is protected from any potential liability because the debt has been settled. So I think that if you are in a situation where there is a suretyship agreement that has been signed, and all of the business partners have signed surety, that a surety risk solution is perhaps considered, and that life insurance is used to fund that risk. The other potential risk that I would like to look at is the loss of a key person in a business. So the one thing that we need to consider is, what is a key person? A key person is someone that is so instrumental in the impact on the business that should something happen to this person, the business could suffer a financial loss. And if that person is so fundamental to the profitability of this business, then surely that person is key in the business. And it could be an employee or a director of the business. And should this person die or become disabled, then the financial impact on the business could in fact be devastating. So there's certain questions that you would need to ask, and that is, well, how will the business be able to continue to operate should something happen to a person who is key to the business? Where would the business find money or funding available to perhaps replace this key person? Maybe they would have to headhunt another person. Maybe they would have to upskill or train an existing employee to replace the key person. And in a situation like that, money becomes important. So how do we get money into the business to ensure that there is no financial impact on the business should something happen to the key person? Another option, again, or a possible solution would be to insure the life of a key person by using life insurance. In this way, we ensure that the business can continue unhampered, where there is some sort of financial sustainability because there has been this cash injection into the business. The business will now be in a position to ensure that they can either headhunt an alternative key person, they could perhaps pay a sign-on bonus, they can ensure that there's enough money available to ensure that they can pay this person that they headhunt, or they could upskill one of the existing employees, and there is in fact sufficient funding available to do that. That the business can sustain itself while this person is being upskilled. And that is why it could be a solution to have a life insurance policy available on the life of the key person that could assist the business with its financial sustainability over a period of time. This life insurance policy could cover certain events. Not only could it cover a death event, should the key man pass away, then there will be a payout, but it could also cater for a disability event or for a dread disease event. So should the key man or key person become either disabled or suffer from a dreaded disease, the business is not impacted financially. So those are two life insurance or company-owned policy risks that life insurance can cater for in respect of your surety risk and your key person risk. I'm now going to hand over to Jacques Retief to discuss your further business risk planning.
Good afternoon, ladies and gentlemen. Thank you for the opportunity. Thank you, Pfizer. So I'm going to look at the second part of the solutioning, and that sits around the business owners. On the same, as you see the slide there is exactly the same as the one that Pfizer looked at, but we highlighted the business owners there. So The solution that is needed here is needed by the business owners at their level. And what we're trying to attempt here, and the solution drives, and then I'm going to have a look at why and how we're going to bring the solution into a business. So what we want to achieve through the solution is to move the shares from, and if I can use the example, upon the death or the disability of business owner C, from his ownership over to business owner A and B. And then also if something should happen to B or to A, the other two, I would always call it the surviving partners or surviving business owners, will then take over the shares from the deceased business owner. So that's the solution. Now, the solution is driven by a contract. So you'll see on the next slide, just to remind you that there's an agreement that we're going to look at on the last slide. That is a very important component of the solution. But the first question, like I mentioned, that we're going to have to look at is the why. And there's no better way to do that than to maybe look at a couple of questions. So if a business owner should die or become disabled, what happens to his business interests? So I think that is a question that unfortunately business owners, and I would almost say financial planners, sometimes don't spend enough time around. It is a tough discussion. We have a scenario always where we have to get business owners to sit around a table and have those tough discussions. Sometimes there's professional individuals, maybe auditors or attorneys, representing some of the parties around the table. But it's an absolute worthwhile tough discussion to have upfront, because once that trigger event happens, and we call it the trigger event, the death or disability of the owner, it will be too late. So let's look at the next question. Spouse and the children inherit the shares. Okay, so let's say the shares in a company's, in case of a company, is it wrong? It's not wrong. It can be done, and in some instances, it might make sense for the children or the spouse to take over business ownership. But how will that affect the business? What are their knowledge and skills? Does it make sense from a business perspective? How will those individuals that do business with this entity react to this? What do they know about running of the business, and do the surviving business owners, how do they feel about this? Okay, so if you look at the last question there, question around cash, where will the funding, what will the source of the funding be to actually make the buying and selling of the shareholding possible? So the next slide clearly indicates that there's two parties that after the trigger event sit on opposite sides of a table. We have the business owners, that the surviving owners, and we have the deceased heirs and dependents. And their wants and needs are different from that trigger event, the death or disability of the business owner. From that point onwards, their wants and needs are most definitely different. And what we want here is a fair result. That's what we're working towards with the solution, a fair result for both of these parties. Now, I've mentioned the agreement or the contract, the buy and sell agreement. Now, I'm just going to go through some of the important components of this agreement. The parties to the buy and sell agreement must be clearly identified. We have had a number of occasions in the past where we had a look and we did an audit on these documents and found that sometimes those parties on those agreements don't even represent the parties on the business anymore. It's very important to identify these individuals as those who are currently in the business. Obligation to buy and obligation to sell. If you look at shareholders agreements or corporate documents in general, will give the parties an option to buy. So the buy and sell is a unique document that obliges and won't give the parties an option to decide if they want to actually buy into the business. Okay, then there's another component that is very important, is the valuation of the business. Now we are lucky that there are in the financial services industry and quite a number of processes that is followed that result in us as an industry giving the clients a very good idea of what we think that business should be valued at. But we will always be open to look at the client's valuation through their auditors or specialists and consider that. We make use of underwriters in our business, and underwriters are the people that assess the financial product that is put in place and assess the value against which we must take cover, and even up to reassurer level, your Munich Re and your RGAs, which are companies that support the financial services industry in delivering large values in terms of cover above 40 million. They all assist in the valuation of businesses to make sure we put the right product in place. Funding mechanism, I think there's no doubt that the life insurance and disability product is by far the most cost-effective solution. And these products in this instance, in this solution, will fund the agreement. And should that should the cover not be sufficient, there is a provision in the agreement that makes it possible for down payment or installments to cover. But obviously that is a situation that we try to avoid, and that can be very easily avoided by making sure that we have reviews, annual reviews at least, on the value of the business, and make sure that the products align with the value of the business. Then the trigger events, as I mentioned earlier, death and disability will be mentioned on the agreement very clearly. And it's very important to also realize that disability on the agreement carries a specific definition, and that definition is aligned with the product that is put in place, the disability product. I've had instances in the past where shareholders' agreements, in case of a company, used a disability definition that was so wide that it could actually happen that that specific individual can be seen as being disabled in terms of the contract, but the product will not pay out because that person is not disabled in terms of the product definition and at that point. So in short, and final word from me, so we have to make sure that we have a buy and sell agreement that is funded by insurance policies, insurance products, to give us that seamless transfer of business ownership. I'm going to hand over to Errol now.
Well, thank you, Jock, and thanks, Faiza. So I have a couple of questions here that I would like us to discuss. Now, I think most people will agree with me that when you think of life insurance, it is a personal matter. But today what I've heard is we're talking about a company taking out life cover. And Jock spoke about another person, a shareholder, taking out life cover on my life, which begs now the question then, when we talk about personal risk insurance and business insurance, and we say it's actually not the same, what is it that we actually mean by that?
I think that with personal insurance, it's really about personal financial planning, and that's all goals-based depending on the person that you are dealing with. So for example, if I myself need to ensure that my children are taken care of should something happen to me, that's personal financial planning. If I decide to use a life insurance policy, then I'm the owner of that policy. I'm the life assured on that policy, and I get to choose who the beneficiary is. And that's what personal life insurance is, or personal financial planning is.
Absolutely. Faiza, I totally agree. I just may want to add there, I think what's very important in answering this question is to look at the purpose of the policy. And the purpose of the policy will drive the whole planning process. So if you look at a life cover, at a life product, the contracts are all the same. They all have life insurance, they all have owners, all have people paying the premium. But why are we taking it up?
I think that is a good point. When you say purpose, let's just unpack that a little bit. I tend to think that if it's personal cover, then I may have some other benefits like a dread disease in case I would get a heart attack. So the purpose is there for a personal reason, and that is to maybe augment my medical expenditure, where business, the why is the business must profit out of this in order to pay certain expenses. That would make sense. So that's what I hear you saying.
Absolutely.
Okay, so now we've established that a company or a business can be the owner of this life policy, and the company is going to pay the premiums. So my question then is, if that is the case, and since it's a business expense, shouldn't those premiums that I'm paying towards that life cover be tax deductible?
So Errol, let's talk about income tax, because that's where the deduction would come in. So under certain circumstances, in terms of the Income Tax Act, there could be a possibility that certain expenses incurred by the company could be tax deductible. And when it comes to the payment of premiums on life insurance policies, then yes, there is a possible tax deduction that could be applicable in terms of the Income Tax Act. But it's not under all circumstances. It's only under specific circumstances that premiums paid on a life insurance policy that is owned by a company could be tax deductible. And that is in instances where this policy insures the business against an operational loss. If that is the case, then yes, the business can claim the tax deduction. But if, for example, the business is claiming or is paying for a policy that insures the business against a capital loss, for example, in a surety risk type of environment where you have a life insurance policy in place to cover the business against that risk, then that is a capital loss. And then the business can't claim a tax deduction on that, on the premiums paid on that policy. But with a keyman policy, for example, that does insure the business against an operational loss, where the business could claim a tax deduction.
Okay, well, that kind of makes sense. So if I were to repay a loan, that is a capital amount. So any expenses attached to that would be a capital expense. So therefore, in your example that you use with the suretyship plan, you will never be able to claim that tax deduction. But then you did say, if the purpose of that life policy was to cover against operational loss, and that would be, for instance, a loss of profit, for training, all of those revenue expenditure, then you may claim a deduction.
Correct.
But now the Income Tax Act, Jock, says that in the case of the latter, where you can claim the deduction against the revenue expenses, we have the choice to claim it or not. How would one go about facing with that?
Okay, so you are talking about the opting in or a component of the act. So yes, you can decide if you want to deduct, and I want to move straight on from there and ask the question. So if you deduct the premiums, you know the proceeds will be taxable, and we have to ask ourselves the question: is that worth it? We're looking at quite a small premium here that's payable and deductible, and we're looking at possibly huge amounts lost on the proceeds. Yes, we can increase the cover and accommodate the taxes, but that will come with an increase in premium as well. So, I don't know if there's an opinion on your side, Fazel or Errol, but I think that's something you have to consider.
I think something that you said earlier, previously, one is often so tax driven. You have to go back to the why. What is it what you really want? If you've got an outstanding debt, let's say your expenses are going to be R1 million, you want to make sure that you've got 1 million available. That is number one. In practice, I find it's not really whether you claim a tax deduction, whether the one is better than the other. Are you talking from a tax perspective? You're talking from a cash flow perspective? And then one must also be in mind that where you may have a policy, initially it was to cover expenses like a key person, but maybe you employed another person, and that need falls away. Now you want to see that the securities for capital, and now you can't because that policy is tax deductible. So in practice, it seems like people opt rather not to claim the tax deduction because there aren't really negative tax benefits. I don't know, would that make sense?
No, that's absolutely right.
Okay, well, let's get to this one. Now, Visa, you told me about income tax. Now, we also talk about debt. Surely there must be other taxes also that's relevant.
Absolutely. And Errol, I think that, one of the things that we often overlook is the estate duty consequences on a life insurance policy. Our starting point is that as soon as you have a life insurance policy on the life of a person, that policy will attract estate duty unless it's exempt in terms of the Estate Duty Act. So when we talk about business assurance and specifically your key man policies or your key person policies and your buy and sell policies, there is a possibility in terms of the Estate Duty Act for those policies to be exempt if they are correctly structured. And that is really what we would want to achieve. We'd want to achieve an exemption, and the way we can do that is by structuring that policy correctly. And then if we do that, chances are the policy will be exempt for estate duty purposes.
You know, what an interesting point listening to there. What I recall, it goes back to the why again. If the purpose of the policy was there to, let's say, have funds available for a key person, then technically one would not increase the value of the company. So there shouldn't be additional estate duty payable. But if you're going to abuse the situation and you're going to use it to pay to the personal estate, that is an example where you would lose the deduction.
Absolutely.
So it goes back to what is it that you really want. It's not for personal. You make it personal and you'll actually pay double tax. Isn't that so?
That's right.
Yeah. I don't know, Jacques, if you want to add anything to that. What about capital gains tax? We haven't discussed that.
Yeah, I think capital gains tax obviously will come in the solution that I looked at. When you sell off shares, there will be capital gains tax payable on those shares. There's nothing much you can do about that. Pure risk policies in the past, if you changed ownership through sessions, it would have become a second-hand policy, so-called, and then the cover would have been capital gains taxable, but that is not the case anymore. So your capital gains tax on policies, on your risk policies, is not something you have to fear anymore. And I want to join in the discussion that you, or the point you made just now around, let's make sure that we almost, and I don't want to call it the default setting, but maybe that is exactly what it is in most instances where we have company-owned policies, the cover will attract estate duty because of the fact, and I'm not going to go into the requirements of the Act, but because of the fact that the life assured alone or together with his family members control the business in most instances, and that's a requirement that pushes us over the edge and makes that policy.
And after we did create wealth, so you must expect to pay the estate.
Absolutely. Yeah. Absolutely.
So what I gather you're saying is that one must be careful, because if there's going to be additional estate duty payable, let's say you want to cover for $1 million, and there's additional estate duty payable, what do I do then?
You have to increase the cover.
So that's why the calculation is so important, because that additional estate duty may be collected from the company. So therefore, you've got to make sure that there's additional estate duty. Absolutely. So that's what you're saying. Absolutely. 100%. And now thinking of the Estate Duty Act, help me here, if it's over 30 million, then you pay 25%. Now with these company-owned policies, you find that they're usually huge. So that's you slap off an additional 25%. Is that not so?
Absolutely. And this might link into a further question that you might be looking at later on, Errol, but maybe putting it on the table now and having a look at estate planning. So when we start looking at estate taxes, we should move straight into a full-blown estate planning exercise to really determine what those taxes are at that
So what you're saying, when you do business financial planning, you actually have to look at the personal, because the one is interrelated to the other.
You can't do it in isolation.
You can't do it in isolation. That makes sense, yeah. Because estate duty is applicable to both.
Absolutely.
To the deceased. Right. So let's move on to some practical issues. Now, Jacques, you spoke about that in a typical buy and sell arrangement is where I would take out life cover upon your life, and in the event of you passing away, I've got the funds available in order to purchase your shares. So your estate would get the money, and I would actually get the shares. But you all spoke about life insurance. So surely there should be some other options as well. Lay out the options on the table for me before I just conclude and say that life insurance is the best.
Yeah.
Professor, please add onto the list. I think it could be quite a long list. But there's two that we come across in practice at the moment quite often, and unfortunately, it's also true that sometimes people cannot get cover because of health issues and so forth. Then we have to start looking at other options, but they are definitely option B and C and D on the list. Loans from a bank. I've seen clients actually get loans from a bank, and that's I want to almost say an awful way to go about this. It's very expensive, but if it's the only option you have, that's the route you take. Then also long-winded agreements that result in down payments at time of death or disability. It takes people 10 years to make down payments to actually pay for those business ownerships. But you don't know down the road, will the company or the business actually survive that term for that individual to actually receive those funds? Because down term payments have long terms in a lot of instances. And then there's one option that I've seen people attempt, and that's saving towards that goal now. Because we're talking about an uncertain event here, trigger event of death and disability. That's a almost impossible task.
Moving goalposts. Yeah, and I think it's important to look at the base agreement, and that's where the funding comes in. That's what we're looking for funding for. So where are you going to find this money in order to fulfill your obligations in terms of the contract? Are you going to go to the bank? Are you going to take out a mortgage loan? Are you going to use your own cash? Or cheapest, most effective solution could be life insurance. You take out a life insurance policy to fund that agreement.
Yeah, you know what strikes me is that it's about the certainty. Now, I actually see this as divorce on death. And what you want is a clean break. So you want to make sure that the funds are available. You don't want to rely on the other person go and arranging and having keeping the shares as security. You want the funds available. The deceased estate is going to transfer those shares. The deceased estate is going to get that liquidity because mommy and the kids actually would need now those funds for personal reasons. So it's a clean break and a certainty that says that the life insurance, perhaps, apart from being the cheapest.
Absolutely.
Okay. Yeah. So, well, let me then ask another practical question. So now, Visa, you spoke about the company that's going to take out a life insurance policy, and the purpose of that life insurance policy is either to cover operational costs or to cover for that capital loss that you have mentioned. Now, how much can I insure? Because this sounds like a good deal. I mean, 1 million, 2 million, 10 million, 50, how much can I, or how would I go about to determine it? What are the risks?
Yeah, I think with the suretyship risk, that's easy enough. It's the amount of the loan that's outstanding. So, you've got to look for insurable interest, and that's where you will find it. Okay. If you are dealing with a key person policy, it's a little bit more difficult, and there's various ways that you can use to try and figure out how much cover is appropriate. So one of the valuation methods is to actually look at the annual income of the key man, and you use a multiple of that. And again, it goes back to underwriting, like Jacques was chatting about. So depending, between 5 and 10 times, but it must be reasonable. The other option could be to be realistic about what the expense could actually be. And that is to look at, well, how much would it cost to pay recruiters to find an alternative key person? Would that person need a sign-on bonus? Are you going to rather upskill an existing employee, and what would the cost of that be? So there's various methods. Jacques?
Yeah, no, absolutely. I mean, you're absolutely correct, Faza. I mean, we have entrenched ways in our industry whereby we determine those values, but we're always open, and we always get reminded by underwriting, please tell the client if he can come up with a value that makes sense. We need a bit of science behind it. So we obviously need a calculation. It's not a thumbs up.
Yeah.
we will have it.
Yeah, you know what, Visa mentioned insurable interest and you spoke about underwriting. What exactly does that mean? Okay, here we go. The Visa's calculations, done our calculations, it's 5 million that we going to insure for. And the company says, I've got the funds. Why don't you insure for 15 million? We can afford it. So Jock, yeah, come to you and says, well, you tell me what is the story about the insurable interest and underwriting.
The insurable interest definition is quite a wide definition, but the question is asked that upon death of the nominated life assured, what damages will the owner of that policy suffer? That's in short. And that is what the underwriters try to determine. And they obviously need information to get to a point where they're comfortable that that is actually going to happen. And that is what they call financial underwriting.
Yeah, I remember that the insurable interest is a concept that came from the UK law. And it actually, if you say the why, the purpose behind it, I mean, I can't randomly go and target life insurance of 50 million in someone's life because there's a risk that I'm betting on him dying to get the money. So it becomes a betting contract that's illegal, and that's actually the insurable interest. So the underwriting ensures that it doesn't become a wager. And we actually had cases like that. I remember about 20 years ago where a person had a whole lot of his employees on a bus and it went down in a pass and they were killed. And then the whole issue was insurable interest. So it's got to be relevant to the actual loss that you are suffering. Okay, so now the same principle, I'm going to ask the same question now, but in this case, it's not the company who's the owner. But here is what Jock spoke about, is that Jock, you and myself, we shareholders, and I take out cover in your life, and you take out cover in my life, and we're actually business partners. Now, I get the part about insurable interest. Okay, I understand that. But how should I value my shares, and what kind of risk is what I should look out for in order to effect that life?
So obviously, we're trying to work towards a market value. And what you don't want is a scenario where the shares are actually eventually bought at a value much lower than the actual market value. And we find sometimes with businesses, just as an example, I've been involved with one of these cases where business owners decide that a value is X, and they go ahead and they put the whole structure in place, and let's say the value comes down to 5 million per shareholding. But by the time that individual passes away, that actual value increased to 10 million. The sale still goes through at 5 million on each one of these business owners, and SARS comes and says, but you bought this value at 5 million less than the market value. And there's donations tax then that comes into the picture. So another form of tax at 20% and possibly 25% that no one can afford to pay at that point. The other is maybe a long shot. Maybe you and Faza can differ from me on this point. Is also in terms of the exemption of the policy, also from estate duty. It's clear in the Act that in the Estate Duty Act that we must determine that the policy was taken out for the purpose of buying these shares. And now the question sometimes arises: if you look at the value of the policy and you look at the value of the share, was that policy really taken out for the purpose of? It's totally two different values. So, maybe that is.
So in that example, we will not get the estate duty relief, and that's what you spoke about, right?
Yeah.
And then you actually pay estate duty. If you're not going to pay the donations tax, you're going to pay estate duty. And then the other risk is that the insurance company may not pay out because the value of the policy is much higher. So the whole agreement can go up in smoke because you had other motives than genuinely to purchase the real value of those shares. I think that sums it up to some extent.
Yeah. And I think, Errol, also just to add on a little bit, it's important to know from a process perspective that when the executor is busy winding up the estate, he needs fair market value in respect of those shares. So the value of the policy must be as close as possible to fair market value of the shares so that you don't run into these issues when something does in fact happen.
So it becomes important to review on a regular basis because of the value of the shares increase or might even decrease.
Yes.
Yeah. Such an instance, you've got to make sure that it's in line.
Yes.
So as a bunch of attorneys around the laptop at the moment, look at us just talking about taxes and technical stuff. What about the family that should be receiving a fair market value?
Absolutely.
Well? I mean, that should be.
Well, let's make it simple. If your shares are $1 million and Jock, I took out life cover on 10 million on your life, then I tell you what, I'm going to keep the 10 million. And maybe I'll pass on 1 million to your family or two. And surely that cannot be the intent. And funny enough, we joke about this, but this is actually what's happening out there. So people who are in these situations should actually revise their structure and say, is it still all in line? Because on a yearly basis, it can change simply because of inflation or the value of the shares and etc. Good. So let's move on to, I think it's my second last question. Now, paperwork. So the company decides, and they do it by means of a board meeting, that they're going to insure one of their directors or an employee. And what a company does is he would draft some kind of resolution to say this was a decision of the company to do X, Y, and Z. And Jock, that goes the same. When we have a buy and sell agreement and you've taken out the life cover, surely it's important to have a written agreement as well. Why is that, and what can go wrong?
I think, when a company makes a decision to take out a life insurance policy, it's important to differentiate a company from its shareholders. It's not one in the same thing. And the way that a company shows how it is acting and its decision-making process is by doing a resolution. So it's important to know who has authority and why this company has come up with a decision to take out a policy on someone's life within the business. And the only way to show that is by ensuring that there is in fact a resolution in place.
Absolutely. Is it not true also, Faiza? I mean, if it's proven that the policy was taken out as a company-owned policy by the life assured, that's the exemption out the door.
Absolutely.
So it also enforces and it gives us that tick box to say at least we comply with that issue and say
yes.
policy was not taken out.
Yes, yes.
Yeah, and the same with the buy and sell. I mean, the buy and sell contract also makes it very clear that the purpose of the product was, okay, we have to comply with a couple of other ticks as well. So it helps from a state exemption, state duty exemption on the product as well. But then also, again, from a practical point of view, if you look at the buy and sell agreement, you don't want a situation where there's no agreement in place. Policies do pay out to the last survivor owners, if I can call them that, and they then decide what they want to do with the money.
And that happens more often than not.
Absolutely, and then they can even decide to not buy it or buy a part of the business ownership.
Yes.
Or close down the business and walk away with the money. I mean, there's a couple of examples out there. So it's and we've been in situations where the policies are put in place, the agreement are drafted, it's in place. All we need to do now is sign.
Yes.
And by just doing that, we remove so many obstacles, Errol. And I mean, I think it's a small step at that point because everything is normally done and in place. We sometimes revisit on review, ask the client, where's your buy and sell agreement? Pulls it out, not signed.
Yeah.
So please, I mean, that is the way to secure and get around all these obstacles.
And it's risk management.
Absolutely.
I want to pick up on something else with Jock and Fiza. Did you confirm? You made the point that if the life policy was taken out at the instance of the deceased, there could be estate duty problems because it is the company. It's not a personal matter. I can add on to that. It was in 2008 that there was a reference guide, and I don't know whether SARS is enforcing this, but they actually say that when you have a deceased estate, the executor must give that resolution or other documentation to the SARS official. Now, I don't know whether they have one or not. And if it's not there, then you have to prove some other way in order to get the exemption, because it's not a right that you have. You have to prove your case. And that is why that resolution is so important. But also, Jock, something about that buy and sell agreement. We tend to think only about the value of the policy and the basics. But think about this, that if you and I, as I discussed earlier, would have a buy and sell agreement and something would happen to you, then your estate has got a policy on my life. Is that not so? Surely I want an agreement. That policy must be ceded back to me.
Absolutely.
What is your estate and beneficiaries going to do with it?
Absolutely. Very good point.
Or it's simultaneous there.
That gives you the option to take back my cover. You might be a person that's sick at that point, cannot get new cover. And,
Yeah.
and that means a lot. And then you can use that cover in your estate planning, in your personal planning.
And onto that, you mentioned in your talk that when you talk about disability, it is defined in terms of the insurance contract. You better make sure that that buy and sell agreement you've got, it actually aligns to that, because you may have an agreement to sell, but the policy doesn't pay out, or vice versa. So once again, show importance always to review. So let's end off. Let's see if we do have some other questions after that. But let's just then, this key concept that I want to drive home. It is important that business people integrate their business and personal financial planning. It is two loose standing events, but it must be seen holistically. And I think we made that point before.
Yeah, I think it's important to know that as soon as you're putting policies in place on the life of one of the business owners, that there is going to be an impact that needs to be considered. So you can't do business planning without doing personal planning. They all do feed into one another, and it's important that when you are looking at business planning, that you are considering personal planning.
Absolutely. Can't agree more.
Thank you so much, guys. That was very interesting. Let's check if there's other questions from the field as well. In the meantime, so far, not. So just to let you know, this is recorded. It will be posted on the Standard Bank YouTube channel. If you want to re-listen to it, it will be posted there. There'll be a thank you note that comes out in a couple of days with a link to where you can get this recording. If you're internal staff, it's on our SharePoint portal. If you want to carry on this conversation, whether personal or about your business with a financial planner, please walk into any Standard Bank branch. There should be a financial advisor or planner that can assist you. If you're too lazy to do that, or you want a more convenient way, please SMS the word guide to 31791. That's 31791. And a financial advisor, financial planner will be in contact with you. Or if you want to use email, you can email SBFC Voice and Digital at standardbank.co.za. That's SBFC Voice and Digital at standardbank.co.za, and a financial advisor will be in touch with you. Thank you very much, Faiza. Thank you very much, Jacques. Thank you very much, Errol. It was very informative. We will have another webinar next month, and an invitation will come out sooner than you know, closer to the time. So in the meantime, have yourself a good afternoon, and we'll see you next time. Goodbye.